is an extraordinary growth opportunity for its use as a transportation fuel in heavy-duty trucking. With that, I'll turn it over to John. John?
Thank you, Adam, and good morning, everyone. We continue to see positive prospects for 2026 and beyond. Despite the extraordinarily cold winter in the first quarter, our upstream facilities performed well, producing more RNG compared with the comparable period in 2025. We generate yearly growth in the biogas resource. In addition, our team continues to make improvements to the performance of these facilities to better utilize that biogas. Together, these improvements give us confidence in our RNG production growth expectations. We continue to advance our in-construction portfolio, and we expect to bring online more than 2 million MMBtu of annual design capacity over the next year or so. We are also continuing to advance opportunities in our upstream development portfolio and anticipate announcing the allocation of capital in 2026 to new RNG projects, as well as to fueling station growth. We are also making meaningful investments across our overall operating platform. These improvements include investments in personnel, technology, and introducing the adoption of artificial intelligence. These investments will support and augment future performance across our existing operating assets and give us confidence in improving results from executing on our business plan. We're seeing a strengthening RIN environment. Since our March call, the EPA released its final set rule with updated 2026 and 2027 RVO targets, which were generally in line with industry expectations. The D4, D5, and D6 prices have moved up dramatically, rising to over $2. We are now beginning to see the D3 RIN participate with the broader biofuel market, with current pricing above $2.50 per RIN, and that may continue increasing over the balance of the year. The work we are doing today is positioning OPAL for meaningful growth over the coming years. While large-scale deployments will take time to fully translate into financial results, we expect growth in 2027 and beyond to be driven by the increasing recognition by fleet operators of crude oil and diesel's sustained price volatility and the benefits of CNG and RNG. I'll now turn the call over to Kazi to discuss the quarter's financial performance. Kazi?
Thank you, John, and good morning, everyone. Before walking through the details, I want to frame our Q1 performance around three themes. First, the platform investments we have been making is beginning to show up in our operational and financial results. Second, our financing transactions have created the runway to allocate capital. And third, our earnings profile is broadening to reduce sensitivity to commodity pricing over time. This morning, we issued our earnings press release and posted an updated investor presentation on our website and filed our Form 10-Q. Adjusted EBITDA was $16.7 million in the quarter compared to $20.1 million in Q1 of 2025. The $3.4 million decline is primarily due to lower RIN prices. D3 realized prices declined 30 cents to $2.41 in Q1 2026 versus Q1 of 2025, resulting in approximately $4 million of EBITDA impact. Operationally, the business performed as expected. First quarter revenue was $73.3 million compared to $85.4 million in the prior year period. RNG production was 1.2 million MMBtu, up 9% year-over-year. The production improvement reflects enhanced execution by our operating team, which we expect to continue driving incremental production and efficiency gains. In our fuel station services segment, first quarter EBITDA was $9.2 million compared to $10.9 million in the prior year period. The $1.7 million variance reflects a combination of lower construction revenues, lower RIN price, and timing of maintenance expenses in servicing the stations. As we continue to grow OPAL-owned stations, we are seeing increasing contributions from the associated tolling activity, which is contracted and volume-based, and therefore relatively lower exposure to RIN pricing. In these stations, the variable costs of gas, power, and taxes are passed through to our customers. We expect the increasing growth of OPAL-owned stations to strengthen downstream earnings stability. We completed several financing transactions this quarter totaling $288 million, which included $180 million of preferred stock facility. In addition, we drew the remainder of our term loan facility with a net amount of $109 million. We ended the quarter with approximately $233 million of liquidity. This amount includes approximately $133 million of cash and short-term investments, $60 million of undrawn preferred stock facility commitments, and approximately $39 million of revolver availability. In the quarter, we sold 11.5 million of ITC credits from Atlantic. We also completed a $100 million of multi-year agreement to monetize OPAL's Section 45Z production tax credits. We maintain full year 2026 guidance. Stepping back, our financial strategy is clear: grow operating and free cash flow, broaden the earnings base to reduce commodity exposure, and allocate capital to the highest return opportunities in our pipeline. With $233 million of liquidity and internal cash generation, OPAL Fuels is well positioned to execute on our strategy. With that, I'll now turn the call back over to John for closing remarks. John?
In closing, we remain well positioned for continued disciplined execution of our strategic growth objectives and the expansion of OPAL's vertically integrated platform. I'll now turn the call over to the operator for Q&A. Thank you all for your interest in OPAL Fuels.
Thank you. As a reminder, to ask a question, please press star 11 on your telephone and wait for your name to be announced. To withdraw your question, please press star 11 again. Please wait while we assemble the roster. And our first question comes from John Annis of Texas Capital. Your line is open.
Hey, good morning all, and thanks for taking my questions. For my first one, it seems like there's real momentum on fleet conversions. Can you provide color on some of the factors driving this, and then over what period do you see this converting into higher dispensing volumes?
Yeah, good morning. This is Adam here, and appreciate the question. It's a variety of factors that we think are going to start to translate into the beginnings of fleet deployments here. I think, clearly diesel pricing, not only the high price of diesel, but the volatility of diesel is what maybe one of the key catalysts to force fleets into looking at other alternatives. I think the regulatory clarity that combustion engines are going to be something that moves forward for heavy-duty trucking. And it was really successful testing of the X15N engine. So all three of those things have lined up for what we believe are going to be some initial deployments here in very large fleets. And, we think we will start to see some contributions in 2027. And, they aren't going to be, extraordinarily large numbers for what the initial set of stations and trucks may be. But we believe it's paving the way for a multi-year, really long-term conversion set for this industry and this sector. So we're excited that, we've been talking about how the math makes sense and how the logic makes sense. And we think it's finally going to translate into some actions on that side of things here in 26.
I appreciate that color. Maybe for my follow-up, you highlighted difficult weather conditions in Q1. Can you help frame how much of an impact weather had during the quarter and your thoughts on the progression of the production ramp over the next 3 quarters to meet your 26 guide?
Yeah, this is John. I'll jump in on this one. Clearly the winter across certainly east of the Rockies was extraordinary from a cold and from an amount of snow standpoint. Despite that, we were able to increase our production compared to the comparable period in the prior year. When we get cold like this, it affects us in 3 ways. The first is that it causes issues in the collection system at the landfill itself, where water and the gas will freeze within the collection system. The second area that it affects us is in our RNG projects directly, where we get some freezing there. And then the third is that we have things outside of our control, such as power outages. All 3 of those affected us this year, but we were able to be resilient in our operations and rise to some of those challenges. We take actions whenever we see these things to try to add, for example, additional heat tracing or insulation or other things to our projects to add to that resilience. But it will continue to pop up on us, particularly when it's an extraordinary winter as it was. Now we're turning into the springtime, and we're seeing the timing when well field expansion projects take place so that we start to see annual gas growth occur in Q2 and Q3 in terms of our, the gas at the inlet. All of our projects are on open and growing landfills, so they continue to take in amounts of waste that result in our inlet gas amounts increasing, and that causes our resource to grow year over year. So there continues to be, in summary, good resiliency to these seasonal issues that we have, and that we continue to see, we'll see growth quarter over quarter during the year as we put some of these additional amounts into the collection. Adam?
Yeah, the only thing I would also add there is not only on the production side that extraordinarily cold weather did result in some higher OpEx as well associated with that cold weather. So, really almost a double whammy there with what we saw in the first quarter. And although we don't give production and earnings guidance by quarter, we do expect accelerating production growth, starting in second quarter and moving through the year.
Thanks, all. I appreciate the time.
Thank you. And our next question comes from Ryan Pfingst of B. Riley Securities. Your line is open.
Hey, good morning, guys. Thanks for taking my questions. Maybe just to follow up on that last one, thinking about expected revenue or earnings cadence through the rest of this year, is there anything else to highlight or to look out for in terms of potential lumpiness, or are we expecting growth on a quarterly basis through 2026?
Yeah, I would say this is Adam here. Certainly it feels like the comps are getting easier for us as we move through the year, where we're crossing over where the RIN price was Q2 from last year into this year. So we're sort of through the tough quarter from a RIN price perspective and see those comps getting easier, particularly in Q3. I would also say, we had in the first quarter of 2025, I would say a higher LCFS credit sale in the first quarter of last year, which also impacted the comp when you're looking year-over-year. Some of our 45Z benefits were masked in the first quarter of this year versus an RNG sale from the first quarter of last year. Certainly it feels like the comps are going to get much easier as we move through the year. All of this was baked into our guidance. We have a couple of nits on the fuel station service side where construction revenues can be lumpy based on the timing of when that project work is done, and a little bit of timing in terms of when we had some maintenance costs. We really feel like the first quarter was sort of the worst of all worlds, and a lot of those things are going to ease as we move through the year.
Appreciate that. Secondly, curious if you could give us an update on timelines for projects in construction, or perhaps more high-level commentary on any particular challenges or positives to highlight around project development more broadly.
Sure. I'll take that one. We're progressing full bore on our Cottonwood, Burlington, and CMS projects. We see these projects coming online towards the end of this year and into the first half of next year. We are seeing that construction timeline advance towards completion. The Cottonwood and Burlington projects are in the field right now with the construction contractors. We're pouring cement at Cottonwood, and we're getting ready to do so at the Burlington project. CMS remains on track as well. On the development side of our business, we're progressing multiple opportunities on a disciplined basis. We take into account our risk-adjusted capital as well as our dispensing availability, which Adam mentioned. We see some logjam breaking there and some positive potential growth. Certainly on the downstream side of our business, we have 16 OPAL-owned stations that are in construction and progressing along. That's kind of where our construction business stands today.
Sorry, just to go back to one of those other quarterly questions on cadence. Our toughest comp is coming in the fourth quarter, where we had a very low SG&A quarter in the fourth quarter of last year. I would just highlight that our toughest quarter will be in the fourth coming up this year.
I appreciate it, guys. Thanks.
Thank you. Our next question comes from Martin Malloy of Johnson Rice & Company. Your line is open.
Good morning. My first question, just wanted to ask about some of the new engine introductions that Cummins has, the X15 and the new X15 and X10 for 2027. Could you maybe talk about the potential impact you see on the demand for CNG resulting from those?
Are you talking about the diesel engine that they're introducing, or are you talking about the natural gas engines? Good morning, and thank you for your question.
The natural gas engines.
Yeah, I think the 15-liter has performed extraordinarily well and really stood up to the duty cycles and the operating requirements of the fleets. We think it's done extraordinarily well. Now you were asking about the X10?
Oh, I'm sorry. I misspoke there. It was the X15. I was just kind of curious if we could get your thoughts as you look out regarding potential return of capital to shareholders through a dividend.
Yeah, we are still seeing very strong opportunities to deploy capital and reinvest in the projects, both on the upstream and the downstream side. So we still think that is the right place to be investing and growing our business, given those risk-adjusted returns. If those opportunities no longer appear in front of us, then we will start to looking at other ways to enhance shareholder value through that, a potential dividend policy or something else. Right now, though, we're really excited about some new upstream projects that we think we're going to be green-lighting soon, and also the potential for OPAL-owned fuel stations in these fleet deployments.
Great. Thank you. I'll turn it back.
Thank you. And our next question comes from Adam Bubes of Goldman Sachs. Your line is open.
Hi, good morning. I know you talked about 2026 fuel station services is going to be a year where biz dev activity sets the stage for future growth. But are we thinking about 2026 EBITDA down versus 2025, or should we still expect growth this year? And then based on dialogue with customers and pipeline of projects, how much visibility do you have on how 2027 could shape up?
Yeah, so this is Adam again. No, we're not expecting fuel station services necessarily to be down in 26 to 25, and it was a noisy quarter for fuel station services, particularly on the GGE volumes, which I know get called out, and are not necessarily significantly impactful to how the profitability of that unit will do for the entire year. I think we called out on a previous conference call that we did have one short-term contract, which is about 2.5 million gallons per quarter, that we cycle through at the end of June here. So, there is a little bit of GGE noise in there. And to give you a flavor for that, we're always opportunistic in our dispensing network and have the abilities to flex up or flex down. And we did have one large contract with a refuse customer that was looking for RNG supply from OPAL Fuels and some of our third-party suppliers as they were waiting for their projects to ramp and fill in their own dispensing capacity that we cycle through now in this second quarter. We do expect the business unit to perform well this year. I think we also said in our guidance that it wasn't necessarily, a outsized year in terms of what the growth would be in that segment. And for 2027, it's a little early for us to really earmark, how quick deployments are going to be and how many stations it means and what it means for gallons that flow through in 27. We do expect some impact from some of these newer opportunities.
Got it. And then just putting the pieces together for the reiterated guide, I think guidance at the midpoint embeds EBITDA up around $12 million year over year. 45Z is expected to contribute $15 to $20 million, and I think RNG fuel production is also rising. If fuel station services is up year over year, I'm just having trouble bridging the moving pieces. What's the delta there? Is that corporate expense inflation or anything I might be missing?
Yeah, I mean, our corporate expense will be up year over year. So that could be one area, and that's in the mid-single-digit million range.
Yeah, let me also add, I think, Adam, this is Kazi. The RIN price variation is also on a year-on-year basis going to be one of the major impacts.
Got it. Understood. And then last one from me. It sounds like, Adam, you alluded to maybe some new upstream projects in the pipeline. And in the past, you've talked about a target to place 2 million MMBtu of landfill gas projects into construction annually. How are you thinking about the range of outcomes this year?
Yeah, no, we will have some new RNG project growth in 2026. And really, what we've been telling folks is that, we're flexible in our thinking, and we're seeing a large opportunity in our downstream fuel station service segment. So, we're going to be disciplined and in our capital allocation, and we're not going to give a specific target for how many new RNG projects from an MMBtu basis, but you should expect growth on both sides of both sides of our business.
Great. Thanks so much.
Next question. And our next question comes from Richard DeDios of UBS. Your line is open.
Hi, thanks for taking our question. You guys have increased your cash pile, and last earnings call, you mentioned that you see opportunistic M&A opportunities. Can you walk us through how you're thinking about capital allocation, like what you're seeing in the M&A market and how it competes with potential projects? Thank you.
Yeah, this is Adam again here. It's pretty interesting. This quarter, we saw the first transaction in our sector in quite some time with Ameresco's transaction with Hazi. And I'm not sure if people have looked through those numbers yet, but it was pretty intriguing to us in terms of valuations and that sort of thing on the upstream part of our business. So we think it's an interesting sector with a lot of opportunities on the M&A side, particularly as a lot of RNG developers may be struggling with executing on their pipeline. But so we're always evaluating and looking at other opportunities. And do think our vertical integration puts us in a pretty unique position, on that upstream M&A side of things.
Yeah.
Can I take a sort of follow-up to that? So there are two things that I would want to highlight. We are also continuing to invest in our existing operating asset base and operating platform to continue to improve the production as well as the overall results. The second thing that I want to highlight is we are very disciplined when it comes to capital allocation. We do have dry powder. Some of that amount is committed, not committed. I think we are going to invest in our existing construction projects. And on top of that, whatever is left, we are going to look at our opportunities in both RNG projects as well as the downstream dispensing station platforms. So we will look at where we should invest to think about portfolio stability over the long term, and diversify having too much exposure in one area versus other. So yes, we do have cash that we have a place to put in. Also, we want to make sure that we are being disciplined in capital allocation.
Thanks for the color on that. And switching to the operational side point of view, given that this year's guide is largely driven by operational improvements, and as you look to scale RNG production over time, what has been the biggest operational learnings from your existing facilities, and how are those learnings being implemented for the development and execution of future projects?
Well, we now have 10 landfill gas RNG projects, and as we've grown quite a bit over the last several years and put more into operation, we really take lessons across the fleet in terms of what works at various projects and bringing that across to our other comparable projects. In addition, we've mentioned in the past how we've upgraded the personnel across our organization, and both in terms of the leading the RNG sector and the fuel station services sector, as well as the employees within those groups. Lastly, some of the improvements that we're making are in the well field itself, putting in technology that helps to improve gas collection, and both gas quality and gas quantity need to, can be improved through that effort. That will also serve to improve the availability of projects. And so, in summary, what you're seeing is better people, better efficiencies and availabilities, and better gas collection, I think, in summary.
Yeah, and just to finish off on John's thought, we believe that that's going to show up both in terms of our inlet design capacity utilization and our utilization of inlet gas, and it really goes all the way from the well field to operational availability and uptime to debottlenecking. So really, it's leveraging where you're benchmarking your best facilities and bringing those best practices across the fleet.
Thank you. I'll turn it back.
Thank you. I'm showing no further questions at this time. I'd like to turn it back to Adam Comora for closing remarks.
Thank you all for your interest in OPAL Fuels and joining us today, and we look forward to chatting with you again soon.
This concludes today's conference call. Thank you for participating, and